to meet you. Thank you very much. My name is Nelson Jane, and I will be your host and moderator for this session. On behalf of our firm, ASC Aliu Salam and Co-Chartered Accountant, it's a pleasure to have you guys with us today. Thank you very much again for joining. Our client, ASC, we are a client-focused accounting and professional service firm, provide support across audit, advisory, taxation, and consulting. Our work centers on helping individuals, professionals, and businesses well positioned for growth. So today, in this webinar, we titled it Understanding the New Tax Reform, Key Changes, Implications, and What Businesses Must Know. So the purpose of this webinar is to give a clear explanation on the new tax reform, the key highlights, and what has changed, and the implications on professionals and businesses. So, and also we want to give you tips for you to be able to stay compliant as it's going to kickstart by January. We definitely will need tips to stay afloat, to stay compliant. So we'll be giving you those tips in this session. And this session is designed to be informative, practical, and interactive. So please you can drop your questions in the chat box, like Mr. Shegun said. You can drop your question on the chat box, and we'll be taking question and answers segments towards the end. We also have a segment of frequently asked questions that is already prepared to answer your questions, to discuss the frequently asked questions that might be in your app. And also we'll be taking questions too, so you can drop your questions, you can raise up your hand towards the end of the session, and we'll take your question. So without wasting much of your time, let's dive in. This session is divided into 4 segments. We have the first session, the introductory remark, which will be taken by our very own ASC partner, Afeez Adembikpe, who also doubles as a finance controller in Fish Glow Holdings. We'll be giving us our opening remark. Then there's the second section that will be taken by our own in-house tax supervisor, Temitope Adekpeko. She'll be taking us on the overview of the Nigerian Tax Administrative Act, NTAA. So she'll be taking the key highlights in that aspect, giving us the key changes and what has changed in that aspect. Also, we have the test session that will be taken by our Mr. Abraham Dunko. He will be taking us on the Nigerian Tax Act, NTA, the overview, the key highlights to it. We'll be taking that aspect. Also, we have the test session will be taken by Moshood Ajeni, a senior chartered accountant of OES Energy Services. He'll be taking us on navigating the Tax Act, practical steps that businesses and professionals should know and have in their pocket. We'll be taking that session. So today, let's dive in by introducing our first speaker, our guest, Mr. Afeez Adembikpe. Thank you very much for joining us. Mr. Afeez, please take over, sir. Thank you, sir.
Hi, Jane. Thank you very much.
Thank you.
Good morning, everyone. Please confirm if you can hear me.
Yes, we can hear you, sir.
Yeah, once again, good morning, everyone, and welcome to ASC Tax Webinar. It is indeed a pleasure to have everyone on this call, and I want to believe that tax sensitization is a discussion that comes timely, because Nigeria, we are at the point where tax reform is no longer an issue that needs to be solved with a long arrow, but an optional thing that needs to be done. So why is this relevant? Why is this important? It is important for us as a country to witness economic growth. It is important for us as a country to witness fiscal sustainability and also to increase investor confidence. I believe the need to reform our tax over the years. Please, can you present my screen so I can speak to it? Shegun, please. So while I wait for them to present my slide, let me also mention that the Nigerian Tax Act is a deliberate attempt not only to modernize our tax system, but also to reduce complexities and align taxation to reality that we have in the country and in the globe as wide. Please, can you present my screen? I can't see the screen from here. Sorry, audience.
Please confirm if you can see it now. I'm presenting already.
I can't see the screen.
Okay.
Can anyone see the screen, please?
No, we can't see the screen. Someone also commented in the chat box.
So while waiting for the screen to come up, from January 1, 2026, Nigeria will experience a new tax rule. I don't want to call it a rule. It's better I call it a tax principle, which implementation will be highly coordinated. Because for now, tax will also form as one of our sources of revenue. It is, but it will be more enforced like before. So that is why, as a taxpayer, I think this is the right time for you to be transparent. This is the right time for you to know more about the tax system. This is the right time for you to, implement what the tax law says and how it affects your business. Thank you. So as we move into 2026, I think we need to know that the objective of the tax law is not to come and winch on us, but a better way for us to do business. It is business enabling. Over time, people have always asked this question: revenue derived from tax.
Yes, I am here. I'm here. So, good morning, and thank you very much for having me. I'm delighted to be among you today, and it's a great privilege and honor to hear my boss speak, Dr. Sheikh Medubi. Thank you very much.
You can go ahead, sir.
That's a tip. That's a good one, though. Okay, please, I need to take it all over again. So basically, my own function is to introduce us into the reform, what the reform is all about, how it's going to help our business as a company, how it will help us as an individual, what is expected of us as taxpayers to know, and how overall gray area can be well understood. So in today's session, we'll be breaking down specific highlights, and also we're going to give you practical steps on how to apply the new tax reform to your business and to individual personal life. Thank you. Please, let's go to the next slide. So like I mentioned earlier, the new tax law is coming with a more simple approach. It will be highly coordinated, and implementation will be of a core priority. So what are the core areas? Beyond the revenue generation, it's come to provide more clarity and consistency to tax administration. My colleague Temitope will be speaking more on tax administration. This new tax law also comes to provide fairness to how taxpayers should be treated. Let me give you a typical example. So before now, we have education tax, we have NIDA, we have Naseni levy, we have a number of little percentage of taxes that we pay, even police levy. The new tax law have consolidated it into what we call developmental levy at the rate of 4%. And the interesting part of it is that the small business and non-resident company shall not pay the developmental levy. So that's a way to know that it brings about fairness to the tax system. From individual perspective, the higher you earn, the more taxes you pay. In Nigeria, we practice progressive tax system, but some people have been able to circumvent the tax law. This new tax provision allows the progressive tax system to stay and well applied. So that's why I say implementation is key for NTA 2025. Speaking to my slide, it's reduced duplication of taxes for businesses. And also it provides a clear threshold for company that is to be subjected to tax. A very good example, before now, we have small company, we have medium company, and we have large company. And each and every one of them have their threshold. The new tax law has streamlined it into just two. Small company with gross revenue below 100 million, and bigger company or large company or standard company, a company that have revenue above 100 million. Now, for individuals, what do we stand to benefit? The higher you earn, the more income, the more tax you pay. What that means is that people below certain threshold of income might not be subjected to tax. A very good example, if your annual revenue is 800K and below, you are completely exempted from tax. So overall, the objective of the new tax law is not only to serve as a revenue basis for the government, but a way to make tax more simple, implementation easy, and brings about ease access to business establishment in the country. Please, can we go to the next slide? So the last part that I will speaking to is, let's do a bit of practical simulation, the difference between the new reform and the old tax law. My colleague will be speaking more on those highlights. But what I want you to know is that in the old tax law, we have multiple taxes. We have multiple levies, but the new tax law has consolidated it and make it more principle and easy for us to know. Again, before now, compliance has been a major issue. We need to run after everybody to pay tax. And when people also pay tax, they don't see the benefit of paying the tax. In the new reform, it is presumed that there will be accountability and that compliance will be not only for just we that we are citizens, but the people that are in political offices, which is what we call accountability. Lastly, in the previous tax regime, administration focused more on enforcement. Tax audits come, debt review come, compliance come. Now, it focused more of engagement. And that is why you see the chairman of the tax reform, Mr. Taiwo Oyedele, continue to engage the stakeholders. And that's one of the core points we at ASC we are trying to do today, to engage us, so to sensitize us about the new tax reform. More importantly, business needs to plan better strategy to be able to fit in to what this new reform bring forward come 2026. Just know that this new reform marks compliance-driven system. It's highly engaging. The final part I want to speak about is the technology-driven part of the new tax law. Before now, we don't have anything like e-invoicing. My colleague Temi Topka will be speaking to that also. The e-invoicing is one mechanism that is newly introduced into the Nigerian tax system. And what is e-invoicing? In a nutshell, for organizations with threshold above 5 billion revenue are expected to integrate their invoicing system to FIRS, so that when they want to generate invoice, they generate it through FIRA designated platform, where specific barcode will be on it and invoicing reference number. And what is the objective of this? Is to ensure compliance with tax principle. Thank you, everyone. Once again, we are happy to have you here. My colleague Temitope will be taking over from here. Thank you.
Thank you very much, Afiz Adembikpe, for that wonderful overview and introduction. Thank you so much, sir. We appreciate you on that. Thank you. So we'll be taking our next session right about now. That will be taken by Temitope Adekbefo. She'll be taking an overview of the Nigerian Tax Administrative Act, the NTAA. Before we go into that, please, to reiterate, please don't forget to drop your questions on the chat box if you have questions, or at the end of the session, you can do a raise of hand to ask your questions if you are comfortable with that. Thank you very much. So, Temitope, over to you, ma'am. Thank you very much.
Okay, good morning. Good morning, everyone. Can you see me? Hello.
Good morning, ma'am. We can't see yet.
Yes, good morning. We can hear you very clearly.
Yes. We can hear you, but we cannot see you.
Okay.
We can hear you and we can see you.
Thank you.
Thank you so much. Good morning and a warm welcome. It is a great pleasure to see so many participants joining us today. We're excited about the conversation and insights that will unfold during this session, and we're confident that today's discussion will leave you inspired, informed, and empowered. Yes, without taking so much of our time, my colleague Afiz Adebimpe has said so much. And I know we have all heard about this new tax laws, the impacts, but then you want something different. So I'll just dive right into the basic understanding the new Nigerian Tax Act. What is changing basically and why it matters? So for years now, Nigeria has relied heavily on its crude oil supply as the major source of revenue. We all know that. And as we all know, there's a constant fluctuation of oil prices have necessitated the need for a more sustainable income stream for the nation, you know, with the constant recurrent expenditure increasing day by day. Now, of course, the country now is looking into tapping into other resources, but the best so far yet that is going to capture everybody's expression, everybody's intention, everybody's interest thus far is this tax. So today we'll break down the highlights and explore what they mean for you and share practical steps to stay compliant while planning smartly under this landmark legislation. So the highlights of this NTA is number one, the Unified Tax Administration. So basically there's no more confusion. The NTA, which is the new Nigerian Tax Administration Act, it was established to modernize the system of and promoting the consistency in the assessment, collection, and enforcement of taxes, where we have different people, like my colleague said, different people from different tiers of the government coming to collect basically the same thing from individual taxpayers. Everything that's now in this NTA, it has been streamlined. The system is now streamlined where the NRS, that is the Nigerian Revenue Service, that is now replacing the Federal Inland Revenue Service, FIRS, to handle taxes for companies, VAT, that's value-added tax, petroleum taxes, mining, even in the mining sector, to mention a few. Now, the Joint Revenue Board too is also coordinating for all tax matters in all the 3 tiers of governments, the federal, local, and states. Now also for non-residents and special categories, while the state tax authorities, that's the RTAs, manage the residents of the nation. So collaboration is encouraged, and this helps with joint audits, shared data, and there is smoother enforcement. There's no more confusion as to who is paying what and to which level of the government. So moving on to the next point, number 2, the VAT returns have been made simple. Can you please move to the next slide, please? Yes, the VAT returns are now being made simple. Now, the value-added tax filings are always due by the 21st of the following month. On or before the due date, a taxable person is going to submit a self-assessment tax return to the relevant tax authority. Yes, for small businesses, that's for businesses that have turnover below 100 million, below 100 million and fixed assets below 250 million. My colleague Abraham will speak to that more. You are totally exempt from paying your value-added tax except you choose to opt in. Now, the deadlines remain firm, and even if filing extensions are granted, your deadlines are still your deadlines. But then they've been the bottlenecks of the process have been removed and filing is seamless. Now there's a smarter debt recovery. Now now this is speaking to the RTAs. The RTAs, that is the state tax authorities, can now outsource tax debt recovery to accredited third parties like banks or agents. This only happens when debts are significant and other legal recovery efforts have failed. Notifications have been sent time and again, and they have been ignored by the taxpayer. Then automatically the taxpayer has received written notification, and the third party responsible for the recovery, sorry about that, and the third party responsible for the recovery of such liability has sent notification again to the taxpayer and it has still been ignored. Yes, then such third party is empowered to pay from hello. Such third party is empowered to pay amounts owed to the relevant tax authority for the coverage for the payment of the liabilities. Now, kindly note that the tax authority still retains the right to revoke the assignment of collecting such debts and assume the responsibility for the recovery of such debts. In essence, what I just explained is now the RTA can have been empowered to grant third-party agents, banks, the right to help recover taxes owed to the government by taxpayers. Now, such third parties would have sent a notification to the taxpayer in question before any deduction is made, probably from the funds kept by such third parties, by funds kept by the taxpayers with the third parties. Now, of course, the tax authority can still withdraw such responsibility from the third party, and at the same time, wherein a third party refuses to refund such monies collected on behalf of the government, yes, there is a penalty to be paid by the third party too. I hope that is clear. Now, moving on to the next point, which is the faster tax clearance certificates. Do you need your tax clearance certificates either for legal reasons, for accounting reasons, or probably you want to secure a loan? Yes. Or secure a loan, yes. Or probably you want to pursue a contract. Now, RTAs have been empowered, have been given enough resources to ensure that this is issued within 2 weeks if your taxes are fully paid. And then, of course, you can explain the reasons why you haven't fully paid such taxes. And transparency and speed are now the new standard. There is no hide and seek anymore. There are no hidden contracts. There are no hidden conditions for meeting the conditions for paying, as much as you have paid, excuse me, the taxes, your all taxes due. Yes, you can get your TCC without stress. Okay, then this speaks to the virtual asset service providers. Now, these are businesses facilitating crypto activities like exchanges of crypto to crypto, crypto to fiat, transfers, safekeeping of crypto, financial services for digital asset offers. Key examples are wallet providers, custodians of such wallets, or even the crypto and exchanges. Now, crypto and virtual asset operators now should take note that they have to pay their taxes. And now there's full attention on them. Yes, because a lot of income does coming through that medium, and the country has been losing that's another source of income for the government anyway, to tax them. And now that there's concentration on them, the non-compliance attracts heavy penalties from 10 million, yes, 10 million for in the first month of non-payment, and 1 million for each additional month, plus the possibility of a license suspension. I hope we all get that for all virtual asset service providers. You have to take note now. It has been noted that a lot of income does pass through. Crypto is now becoming a highly demanded source of currency. And as such, please let us keep it in mind that we have to follow what has been said by the law. So there are now stronger law enforcement powers that have been given to the RTAs. That's point 6. The RTAs can now work with the law enforcement agents. Point 6, please. The RTAs can now work with the law enforcement agents, obtain warrants, and even require access codes to investigate tax offenses. Yes, this has been on before now. A tax representative or the relevant tax authority of businesses, of individuals, yes, to have access to a lot of information concerning all taxpayers in the country. Yes, it is not in a bid to, I need to caution us now and reassure us that it is not in a bid to violate our privacy, but basically it's just in a bid to investigate tax offenses. That is all. And the digital compliance and reporting, that's the use of electronic fiscal systems. The use of electronic fiscal systems to enable real-time transaction reporting, which will which will eventually reduce to a large extent avoidance and evasion opportunities. Now, this the use of digital compliance is, excuse me. The use of digital compliance now comes in with the use of the e-invoicing my colleague spoke about. Who is that? Do you need
Please, let's all mute our mic. Thank you very much. Let's stay muted. Thank you very much all. Thank you. Temitope, you can go ahead, ma.
Okay, thank you. So the use of the e-invoicing that my colleague initially spoke about basically is to ensure that it will enable real-time transaction reporting, and also the VAT for VAT registered companies as a value-added tax. We can see this already operating in the use of tax promax to file all your VAT returns, your CIT returns, by the company, so by taxpayers, individuals and taxpayers. And so compliance is no longer optional for each and every one of us when it comes to the empowerment of the RTs. Now, moving on to number 7, which is special reporting for priority companies and incentive beneficiaries. Now, this replaces the former pioneer status incentive with a new economic development incentive. That's the EDI. Now, these companies now have to meet a specific investment threshold in the qualifying capital expenditure incurred by such companies. So companies with priority status or tax incentives, e.g. the most popular agricultural firms or companies that are into crop production, livestock, aquaculture, to mention a few, the manufacturing companies, the petroleum refining companies, the hospital. Could you please let me take a moment and take a sip of water? Hospitals, all these must file additional returns, ensuring full disclosure and accountability. Now tax, number 8 now, tax refunds with clear timelines. Tax refunds must be processed within 90 days or 30 days for VAT. Overpayments can also be set off against future liabilities. Claims must be made within 6 years. Now, in the time past, oftentimes some taxpayers make errors, probably accounting errors, and overpay their taxes in a particular month or in a particular year. Now, RTAs or the relevant tax authorities have been mandated to refund such excess payments made to them. However, you can also still keep these monies with them, this overpayments with the relevant tax authority, and have it offset your future tax liabilities. So perhaps you're not interested, you just make your claim and with the adequate supporting documents to ensure that you get to get your refund. And of course, these claims must be made within 6 years and you get your monies back. Now, number 9, which is quite interesting, power to distrain for outstanding taxes. This comes from Section 61 of the Act, where RTAs can seize and sell taxes to recover unpaid taxes. This means they can confiscate immovable or movable properties, such as for unpaid taxes by defaulting taxpayers, but only, and I repeat, only with the High Court approval, which means no tax representative can come to your company doorstep and claim that or say that they are empowered to seize your property and they will use it to recover your unpaid taxes. So which means you must see the High Court approval. Now, the beautiful part is the taxpayer can object in writing within 30 days of receiving the notice. Yes, you can object, and if objection is not resolved, an appeal can be made to the Tax Appeal Tribunal. Yes, we taxpayers now have that recourse. It's no longer jungle justice now in Nigeria. So the third party collection comes to play here, wherein there's still a bit of confusion, or there is no clarity. The third parties can appoint the third party, that is the bank, where the funds of the taxpayers are held. This is what I was trying to explain earlier, where the funds of the taxpayer are held to recover the funds from the funds held by on the taxpayer's behalf. Now, wherein that is not going to be sufficient, or that does not work, or the taxpayer doesn't have sufficient, or doesn't have funds to cover the bill with any third party, that is when, of course, there will be a recourse to obtaining approval from the High Court, and thus seizing such properties to clear unpaid taxes. Now, please note that any excess proceeds from sale of taxpayers' properties must be refunded within 90 days. Also, it must be refunded within 90 days, yes. It might seem like, that's not good enough, but the truth is, it is better to have something left, in my opinion, than have nothing at all. Now, moving on to the next one, which is the 10th one. There's a mandatory tax ID registration. A taxable person is anyone engaged in a trade or business or economic activity to earn income. Now, this is a very interesting topic. I was still asking, clarifying this particular part, because I'm sure a lot of people on this call are interested in it. Now, everyone earning a taxable income in Nigeria must register for a tax ID. Individuals, businesses, non-residents, government entities, that's the ministries, departments, and agencies, at the different levels of government. Yes, the federal, state, and local must also secure a tax ID. Now, the financial institutions will enforce this, which will, of course, enable will enable the nation to formalize the tax informal sector. And now the truth is, the question I asked just before coming online, and I already knew the answer, I just needed to clarify. Was, what about a student who has a side hustle in school, still within teenage age of probably 18, but has a compulsion for selling? You will think, okay, will this person be taxed? Yeah, the person is actually earning income. This is a business. So yes, the person such an individual needs to obtain a tax ID, because such a person at the end of the day will be scrutinized for payment of tax. So it's best the person starts early. I'm sure you're still not convinced, but we'll answer all of that at the end of during the frequently asked questions section. Now, expanding the NTA also is expanding the tax net. That'll be number 10. NTA brings in more businesses and individuals into the system, especially from the informal economy. So simplified returns will make compliance easier for low-income earners. Yes, this is a build-up from the initial point where everybody now has what we call the tax ID. Everybody now has a tax ID. So a lot of people are now in the tax net. Like the scenario I explained initially, the student in school selling items is actually in the informal sector. So yes, NTA now has more people to help increase the general running of the economy of the nation. Now, moving on to the last and most beautiful point, there's mandatory disclosure of tax planning. So any transaction, I need companies to note at this point that any transaction designed to gain a tax advantage must be disclosed upfront. This helps authorities spot aggressive tax strategies early. I need to clarify on this, I hope you understand what I'm trying to say. This scenario works most of the time with manufacturing companies or any produce company. Oftentimes you have your products become obsolete or they go bad, and you need to remove them from your stock list or your inventory list. Of course, you'll be claiming a loss at the end of the day because you have removed a significant part of your stock. Please notify the relevant tax authority that your company is domiciled, because when you notify them and they are aware you're going through something like that, it will help them, it will enable them plan. Hello, sir. Could you please mute?
Let's stay muted, sir. Hello, please mute yourself as you enter the meeting, please. Thank you. Thank you. All right.
Thank you. So, like I was saying, it will, notifying them will let them know that you're not evading tax. Oftentimes, if probably you get a visitation, or the company, the manufacturing company or a produce company gets a visitation from NAFDAC, and they're like, no, this particular batch of products that you were actually expecting to earn income from cannot go into the market, and you have to destroy it. And you cannot, there won't be sufficient time for you to call on your tax representative managing your company, or there won't be sufficient time for the notifying the tax authority and getting a feedback from them for them to visit your company and view what you want to destroy. I take a picture, send a mail, take a video and send it to them. Let them know well ahead before your tax audits. This will enable them, the tax authorities, know that yes, truly you have covered your basics. You have done the necessary things to ensure that they are not misinformed, that you want to deliberately avoid tax, you know, and then so everybody is at the end of the day properly settled. Now, why all this matters is that for why the new tax law, the NTAA matters is basically for businesses. You now have clearer rules, you have faster processes, you have stricter enforcement. For individuals, there's more transparency, there's more simplified compliance, and there's stronger rights. A typical example is the refunds, the collection of your TCCs in time. And also for Nigeria, yes, a broader tax base, a better defined revenue collection, and fiscal sustainability for the nation. Rather than relying on one particular sector, you now have a larger, a wholesome means of sustaining all fiscal policies within the nation, and we'll be the better for it. Now, the takeaway of at the end of the day, what we're going away with is this is not just about compliance, basically. It's about building a smarter, faster, fairer tax system. Now, businesses and individuals who understand and adapt quickly will not only avoid penalties, but also position themselves for growth in Nigeria's evolving fiscal landscape. So at this point, I want to say a wonderful thank you. And if there are questions, I'm sure there are still questions, please drop them in the chat box. We will attend to them as soon as we're done with all the presentation. Thank you very much once again. Over to you, Jane.
Thank you, Temitope. Thank you so much for that insightful session. Like I learned a lot, and I'm very sure people out there are in this call right now are learning a lot too. Thank you for that insightful session. Thank you so much. So we'll be moving on to the next session. Before we go into the next session, please and please, if you once you come into the meeting, ensure your mic is muted or you're in a very quiet environment so that you not distract our speakers as they speak. Thank you so much. So now we'll be moving to the next session, the third session, that will be anchored by our in-house tax manager, the person of Mr. Abraham Donku. He will be taking us on the session Nigerian Tax Act, the NTA session, the overview and the key highlights. So thank you very much, Mr. Abraham, for joining us. Over to you, sir.
Thank you
Thank
very
you.
much, Jane, for that warm introduction. Good day, everyone. It's a pleasure to be here. So building on the foundation led by the existing speakers, I'll be taking us through the key changes introduced by the Nigerian Tax Act, as well as practical impact for businesses. All right, so the first key highlight I'll be looking at is the first point, which is clarifying residency status for individuals. Clarifying residency status for individuals. Now, under the previous tax framework, the old tax law did not provide a precise definition of who qualifies as a resident or a non-resident individual. But the new Nigerian Tax Act now introduces a clearer and more structured residency test for individuals. Now, the first one is that if a person is domiciled here in Nigeria, that person becomes a resident individual. That is, if the person is based here in Nigeria, the person is a resident individual and should pay tax here in Nigeria. The second test is if the person maintains a permanent home available for personal or domestic use within Nigeria. Yes, that person becomes a resident individual. And the third test is if the individual has significant economic ties as well as immediate family's connection in Nigeria. Automatically, the person becomes a resident individual and whose taxes is payable in Nigeria. And then the last test is the popular test. That is, if the individual is physically present here in Nigeria for at least 183 days, the person is a resident individual and is liable to pay tax in Nigeria. So this is one of the key change that the NTA has introduced, which gives a clearer, definition as to who is a resident individual, what are the necessary tests that will be looked at to determine if you are liable to pay tax in Nigeria or not. The second key highlight I'll be discussing is the second point, which is a revised income tax band and tax rate. Now, the NTA, the Nigerian Tax Act, has introduced a more progressive personal income tax structure by updating both the income bands and then the applicable tax rate for individuals. And we can see the new personal income tax band and tax rate below. So for people who earn 800,000 and below, their tax rate will be 0%. Essentially, this means that they are going to be exempted from paying tax. So people who are also earning minimum wage as well will be exempted from paying income tax. Now, for individuals who earn above 800,000 up to 3 million, the tax rate for that income band is 15%. Above 3 million to 12 million, the tax rate is 18%. Above 12 million as well, and up to 25 million, they're going to be taxed at 21%. And if you earn above 25 million to 50 million, your personal income tax rate is going to be 23%. And for individuals who earn above 50 million, their tax rate is going to be 25%. 25%. So what you will find out is that for the first three categories, the first, second, and third income bands, your personal tax will be slightly lesser to what you are paying in the previous Personal Income Tax Act. And then from the fourth to sixth income band, your taxes will likely increase slightly. So let's look at the third point, the third key highlights are introduced by the NTA. All right, so the third point is introduction of rent allowance or rent relief, which replaces the good old consolidated relief allowance. Now, I'm sure we are familiar with the old consolidated relief allowance, which is computed at, effectively 21% of the person's gross income. So if you earn an income of 100 million, for example, your CRA effectively will likely be 21% of the 100 million. That means your relief, what will be deducted from your income before your income is taxed, will effectively be 21%. So that has been removed. That has been removed. And what we now have is the rent allowance or the rent relief. And the rent relief or the rent allowance is computed at the lower of 20% of your annual rent and 500,000. 20% of your annual rent and 500,000. So whichever is lower. So this then means that there's a ceiling. The rent relief you are claiming cannot be more than 500,000. Cannot be more than 500,000. Basically, for you to qualify for this relief, you also have to provide evidence of your rent agreement or your rent receipts. Rent agreement or your rent receipt. There's a big dilemma here, which we'll be looking at when we are taking our questions as to if a husband and a wife, both live in the same apartment and their rent is being paid. The big question now is, who is going to claim the rent relief? Will it be the husband or will it be the wife, or will both of them claim? So we'll answer this in a question and answer section. The fourth key highlight I'll be discussing is a tax exemption for non-resident technology employees. Now, under the NTA, the employment income of non-resident individuals working for startups or companies engaged in technology-driven services, as well as creatives, those in music, art, and entertainment, their income now is exempted from tax. Their Nigerian income is exempted from tax, as long as their income is taxed in their respective country, in the foreign country that they reside in or they are domiciled in. So that means that those are IT professionals, those creatives, those entertainers who reside in other foreign countries like the US, the Canada, Europe, and the likes, that earn income from Nigeria. This income is not going to be taxed as long as it is taxed in their own country. So let's look at the next key highlight we'll be discussing briefly under the Nigerian Tax Act, which is the fifth point: expanded definition of dividend. Expanded definition of dividend. Now, the very common old idea to dividend is basically returns on investment, right? When you have an investment somewhere, shares or what have you, and then at the end of the fiscal year, or based on the declaration policy, you are being paid returns on your investment. Now, the NTA has given or expanded that definition to now include capital items, capital assets that is shared, that is distributed, upon liquidation of a company. So when a company is undergoing liquidation and they share capital items, they share capital assets, or any form of item that is capital in nature, all right, those distributions to shareholders, those capital items that is shared, we constitute an income and is taxable in the hands of the respective shareholders. It's taxable in the hands of the respective shareholders. So for income tax purposes, they will be recognized as as a chargeable income, and will be taxed in the hand of the respective shareholders. The next point we're looking at is point 6, which is the introduction. Point 6, which is the introduction of controlled foreign corporation or controlled foreign company rules. Now, the NTA has introduced the CFC rule, which is aimed at curbing or controlling or minimizing profit shifting by Nigerian companies, all right, to their foreign subsidiaries. And essentially, this happens when, those foreign subsidiaries have a lower tax regime or a lower tax rate. Now, what the NTA has done is that where a foreign subsidiary accumulates profits that would otherwise have been distributed, without disrupting or without detriment to the going concern of that foreign entity. That undistributed profit that would have otherwise been distributed will be treated as taxable income in the hands of the Nigerian company. In the hands of a Nigerian company. So what they are simply saying is, if a Nigerian company has a foreign subsidiary, right, any undistributed profit that foreign subsidiary earns that can be distributed without affecting or causing harm to that foreign company, if not otherwise distributed, will be treated as distributed in the hand of the Nigerian company, even if they have not received that income. It will be assumed that it has been distributed and it will be taxed, and the tax authorities will request a tax of that income in the hand of the Nigerian company. So now let's look at the next point, which is the seventh key change. So we have a revised tax rule for non-resident persons. A revised tax rule for non-resident persons. Now, what the NTA has done is that when calculating the taxable profit of a non-resident person that operates through a permanent establishment in Nigeria, permanent establishment simply means a fixed base, a fixed location where a company operates from, okay, which can be a physical office, which can be a rig, an oil well, that can be attributed to that company as a physical fixed presence. Okay, so for such non-resident companies, only expenses that directly relate to the income generated, or that the profit that is attributable to those fixed base or those permanent establishments will be allowable or will be tax deductible. In addition, there is no, these expenses like royalties, fees, or similar payments to those non-resident companies or non-resident institutions for the use of their patents or intellectual property. These expenses are no longer allowable. And this is a major and very big shift, because businesses that pay royalties or pay fees, for the use of intellectual property or patent rights, will have to then check, because these expenses, if they pay them when their taxes are being computed, they are going to be added back to profit and taxed. Now, the tax payable by this non-resident company must not be lower than the withholding tax that would have been deducted at source. That's a key change as well. If it is lower, the company will be required to pay a top-off tax to match up with that withholding tax rate. And lastly, if the non-resident company has no income that will be subjected to withholding tax, their minimum tax payable is 4% of their Nigerian income, 4% of the income that they earn from Nigeria. Now let's look at the next key change that we'll be discussing briefly, which is the 8th point. Which is the 8th point. So that will be on proration of capital allowance. Now, under the Nigerian Tax Act, capital allowance will be prorated only when the company's non-taxable income is above 10%. It then means that if a company's non-taxable income is below 10%, you will not be allowed to prorate capital allowance. Also, initial allowance has been scrapped, investment allowance has been scrapped, capital allowance is now on a straight line basis. That is just the annual allowance. The next key change we're looking at is the 0.9, which is on company tax rate. Now, the NTA provides that small companies, that is those with an annual gross turnover of 100 million and below, as well as those whose their total assets does not exceed 250 million, or their company income tax is now going to be at 0%, which then means that small companies by extension will no longer be paying company income tax, no longer be paying company income tax. Now, large companies, that is companies with income, an annual gross income of above 100 million, will be paying income tax at the rate of 30%. Although the plan in the coming years is to reduce the income tax rate further downwards to 25%, and this will be communicated by an order issued and signed by the president. The next key change I will be discussing briefly is on chargeable gains and assets. We understand that the old Capital Gains Tax Act has been repealed, and the NTA clearly explains or clearly defines chargeable gains as income taxable under the Nigerian Tax Act. Now, the NTA in section 34 gives us a list of chargeable assets that includes all forms of property such as shares, options, rights, debts, digital assets, intangible property, as well as foreign currencies. However, it then exempts gains that is earned from disposing shares in Nigerian companies. As long as any of these following is achieved, the first one being that if that sale is less than 150 million naira, all right, and the chargeable gain that is earned from that disposal does not exceed 10 million, it will be exempted from income tax. The second condition is if the shares is transferred between approved parties under a regulated securities lending transaction, it is also going to be exempted from income tax. And the third condition is if the proceeds from such disposal is reinvested within the same assessment year into shares of Nigerian companies. Such disposal, such sales of shares will not be liable to tax, will not be liable to tax. So let's look at the next key highlights introduced by the NTA. So that will be point 11 now. That is on input VAT claim. That is on input VAT claim. Now, recoverable input VAT now covers VAT paid on services and fixed assets, as long as those items are used or consumed or supplied in the course of making taxable supply. Prior to now, you can't claim input VAT on services, you can't claim input VAT on fixed assets. VAT on services are expensed, VAT on fixed assets are capitalized. But now, as long as the service or the fixed asset is used in rendering the taxable supply that is consumed, you can now claim such input VAT. The next change we'll be looking at, which is point 12, is effective tax rate. So the NTA introduces a 15% effective tax rate. It's calculated on a company's net income. Now, this net income refers to profit before tax, as shown in the company's audited financial statements, excluding franked investment income. Now, franked investment income means income like dividends and interest from unit trust scheme. So when computing effective tax rate, we're going to take your profit before tax in your account. And then we are going to deduct dividend and any other frank income like interest from unit trust scheme in computing your effective tax rate, which is now going to be 15% on your net income. Now, this rule applies to companies in two categories. The first one is companies with annual turnover above 50 billion. So if your year and your company has an annual turnover that exceeds 50 billion, it then means that the tax you pay in Nigeria must not be lower than 15% of your net income. 15% of your net income. When it is less than that, you have to now pay what is called a top-off tax to meet or to match that 15%. And the next category is members of a multinational enterprise. Okay, members of a multinational enterprise that has a global turnover of 750 million euros and above. Of 750 million euros and above. So the same rule applies if you're a member of a global multinational company and the global income of this group exceeds 750 million. The tax authority is going to do a check. So, okay, what tax? How much is your tax that you are paying to Nigerian government? You identify that tax. Okay, you apply 15% of your net income. If the tax you have paid is higher than 15%, you are safe. But when the tax you have paid is lower than 15%, you are not safe. You have to now pay a top-of tax to match and meet that 15% effective tax rate. So let's look at the next key change I'll be discussing briefly, which is the 13th point. Yeah, introduction of development levy. So the NTA has consolidated several existing taxes and levies. This includes education tax. This includes the police levy. This includes our NITDA, NASENI, and a whole lot of other levies that companies, pays. This has now been consolidated to one levy, which is called development levy. Right, so companies no longer have to, bother themselves saying, okay, what are the various levies we are exposed to, and then now trying to pay those levies one after the other. Companies now pay just one levy to the government, which is called the development levy, and then it is now going to be shared. The government takes that responsibility of sharing the development levy to the respective parties. So below is a list of how this development levy will be distributed. So we can see for the education fund, the Nigerian education loan, the IT levy, the NASENI levy, the National Board for Technology Incubation, the Defense and Security Infrastructure Fund, and National Cybersecurity Fund. So this is how this development levy is going to be shared by the government. So let's look at the next key change, or key highlight quickly. Taxation of approved entities in free trade zones. Now, Section 60 and the second schedule of the NTA set out the rule for companies operating in EPZ, that is in export processing zones. Now, under these provisions, an EPZ entity, an export processing zone entity, may enjoy tax exemptions on their profits, provided that certain conditions are met. So essentially, companies in these zones are exempted from tax as long as they meet these criteria. The first one being that if an EPZ entity generates all its sales from exporting goods or services, or from supplying inputs used mainly or solely for producing goods or services that are meant for export. Essentially, it means that if this company's input or output is exported, they're exempted 100% from paying tax in Nigeria. The second criteria is if this entity makes not more than 25% of its total sales to a Nigerian customs territory. That is, if not more than 25% of their output is sold locally, they are exempted from paying tax 100%. And the third condition is if these entities ensure that any sales that they are making locally is made to companies in the upstream, midstream, or downstream petroleum sector, they are exempted from paying income tax. They're exempted from paying income tax. Now, if an export processing company sells more than 25% of their output locally, that percentage will be taxed. That percentage that they sold locally will be taxed. And starting from January 2028, all sales that is made locally, will be taxed. Basically, the government wants companies in this zone to focus on exports. Companies in this zone to focus. So if you are here and then your company is is in any of the export processing zones, you have to do a quick critical examination of this condition so you can tax plan properly. All right, the next key change we'll be looking at is the 15th point, which is deduction for research and development. Now, the NTA revises the allowable deduction for research and development. Under Section 164, companies can now claim their research and development cost up to 5% of their annual turnover. Now, this replaces what we have under CETA, which used to be 10% of total profit. So basically what the NTA has done has given companies, a larger chunk to be allowable for their research and development costs, because 5% of annual turnover will likely be higher than 10% of the total taxable profit, which is what we used to have under the former Company Income Tax Act. So let's quickly look at the next key change that we'll be discussing. The next key change. All right, so we are looking at the 16th point, which is the Economic Development Incentive, EDI. Now, this replaces the previous Pioneer Status Incentive, the PSI. In summary, the EDI is now more performance-driven. The PSI, which is the Pioneer Status Incentive, as long as you meet the capital requirements, you are good to go. You can enjoy, or be exempted. You can enjoy your tax holiday for 3 years and even extend for 2 more years or for 3 more years if you are into primary agriculture production. But that has changed. The EDI is more performance driven, more performance focused. So every year companies, would have to submit their annual performance report. And if you meet the key performance indicators, your status will be maintained. But if in any year your performance drops, you are at risk of losing your EDI license, and then your tax holiday is seized, and then you start paying tax like every other company. So that's a very key, and quick summary of the EDI, which replaces the Pioneer Status Incentive, which before now was more of the capital incentive nature. Once you have the qualifying capital threshold, which was 100 million, you can enjoy your license and you are covered, you're exempted from paying tax. But that has changed now. Once your performance drops, you can lose your license and you likely pay tax like every other company. So let's look at the next point briefly, which is the 17th point. Now, we'll be speaking on the integration of capital gains into the income tax system. Now, I think I mentioned this earlier, that the NTA repeals the Standalone Capital Gains Tax Act and now brings gains from disposal of assets or property into the scope of taxable income under the Act. Now, the NTA, the Nigerian Tax Act, does not increase the capital gains tax from 10% to 30%, as what we have out there. Many people are saying that, oh, the Capital Gains Tax Act rate has been increased from 10% to 30%, but that is wrong. It doesn't increase the capital gains tax rate because the Capital Gains Tax Act has been repealed. What it has done is that it has position it in such a way that if you are an individual and you dispose an asset, that gain from that asset disposal is taxed in your personal income tax. If you're a company and you dispose an asset, that gain is taxed alongside your company income. All right. Now, it then means that if you're a company, for now, you are going to be paying gains, tax on that your capital gain at 30%. And when the tax rate reduces to 25%, you're going to be paying tax on that capital gain at 25%. It also then means that if you are a small company, that is, your turnover is less than 100 million, and you dispose of an asset and you have a capital gain, you are not going to be paying tax on your capital gain. So saying that the capital gains tax rate has been increased from 10% to 30% is wrong. Because for small companies, we're not going to be paying their income tax, and by extension, you will be paying tax on your capital gains. I hope that is clear. Now, let's look at the 18th point, which is introduction of the Tax Ombudsman Office. The Tax Ombudsman Office, the 18th point. Essentially, the NTA establishes the Tax Ombudsman Office, which is to act as an intermediary between taxpayers and tax authorities. So they are independent arbitrator. All right, they are tasked with reviewing and resolving, complaints, issues, queries, the grievances of taxpayers with respect to their taxes, their levies, demand notice, regulatory charges, and tax audit liability that is being slammed on companies. So the Tax Ombudsman's Office, they are a middleman between the tax authority and then the taxpayers. So when the tax authority is not listening to you or doesn't want to accept a position, they are proving stubborn, you can take the case to the Tax Ombudsman Office, and they act as an intermediary to review your case. And if you have a case, if you have a point on your behalf, they can then engage the tax authority. So let's look at the next point, which is the 18th point we have on our material. Now, briefly, the 19th point, apologies. And briefly, we're looking at the VAT at zero rate on essential goods and services. Now, the NTA has broadened, as in to cover essential goods and services, including basic food items, medical and pharmaceutical products, essential books and materials, electricity generation and transmission, medical equipment and services, tuition fees, exports, excluding oil and gas. Now, this change allowed businesses supplying these items. This change allowed businesses in this sector to recover the VAT that they have incurred, the VAT that they have suffered, the VAT that they have paid on their cost, even though the items are zero rated. A benefit that was previously not available under the former value added tax act. So the list of zero rated items has been increased, and companies who are into any of this sector can now recover those VAT on their cost. Now, the next point we'll be looking at is the updates to the VAT sharing formula. The NTA has revised the VAT revenue distribution among government tiers, because there was a lot of debates and concerns around this, that states that generate a huge chunk of this VAT is now sharing the VAT revenue in the same portion with states that contribute lesser VAT revenue, lesser VAT income. So this has slightly been balanced. The federal government's portion has been reduced from 15% to 10%. State portion has been increased to 55%, and local government has been increased to 35%. And this is now shared as follows: 50% based 50% will shared equally, 20% based on population, and 30% based on the place of consumption, based on the local government that generates more consumption. Hopefully, in the future, we'll have more clarity regarding this, more creative regarding this sharing formula. Now let's look at the next slide, which will likely be the last slide in my section. Increased penalties for non-compliance. Increased penalty for non-compliance. The NTA introduces higher and new penalties for tax non-compliance, including failure to file returns. So when companies fail to file their returns, for the first month, they are going to pay 100,000. For subsequent months, it will be 50,000. This is a big change to what we had before. What we had before was 25,000 for the first month and 5,000 for subsequent months. So if companies are not careful and if they are not compliant, they will likely be paying penalties that will be matching the tax that they should be paying. Now, one of the new penalties we'll look at quickly is the penalty of 5 million for awarding contracts to individuals or companies that are not registered for tax. This is a major pointer that companies need to try to avoid. If you contract or you deal with any person that's not registered, the penalty you will be paying will likely be more than the income you even derive from such contract or from such transaction. So companies have to ensure that the contractors they are dealing with are registered, they provide them with their TIN, and they verify that TIN number, because sometimes taxpayers can be very, very funny. The next key change that we're looking at is the elimination of CAFA, which is the certificate of capital acceptance on fixed assets. So the elimination of CAFA as a requirement for capital allowance. So when you look at the NTA, you don't see it mention CAFA. So this then means that companies can claim their capital allowance, without having to disturb themselves about getting to seek approval, getting to pay the relevant fees to obtain a CAFA certificate, which is then required before they can claim their capital allowance. So companies are allowed to claim their capital allowance as long as you have paid VAT on your assets, on your capital expenditure, and you have paid the relevant customs duties on your assets, or your qualifying capital expenditure. And the last point that I'll be discussing in my section is the removal of capital allowance restriction. The removal of capital allowance restriction. So prior to now, capital allowance is restricted to 66 to third of the adjusted profit of companies, but before they can then claim. So what you have is that companies may have sufficient capital allowance to reduce their profit, which in line will make them pay no tax, right? But because of the restriction, they will now claim lesser capital allowance and then pay tax. But this restriction has been removed. Companies can now claim their capital allowance 100% to the extent that their profit can take. Thank you, everyone, for your attention. It's a pleasure to speak and to be here. I'll let my host, Nelson Jane, take it over from here. So Jane, over to you.
Thank you so much, Mr. Abraham. Thank you. That was a very comprehensive and insightful session. Like, especially in the part where you talked about claiming of that rent relief. That question, I've heard that question so many times, and it's really a question on many people's minds. And I'm glad we'll be having a session to clarify that. Thank you very much. And also this part where you talk about the contract with people that don't have a TIN. Now, from next year, I'm very sure many people don't want to be doing contracts with you if you're not registered for tax. So it's very important you get your TIN number and your TIN and register with the government for your tax. Thank you so much again for that session, Mr. Abraham. So going forward on this same session, we will go to our fourth segment that will be taken by Mr. Moshood Ajeniya. He's a senior accountant with OES Energy Services, and he will be taking us on navigating the new tax act, the practical steps businesses and professionals need to take. He will be taking us on that session. And let's welcome Mr. Moshood as he takes that session. Mr. Moshood, thank you very much for joining us. You can go ahead, sir.
Thank you very much, Jane, for
Thank
having me.
you, sir.
Thank you very much.
Welcome, sir.
Yeah. So basically we have thank you, Abraham, again for demystifying all those new tax acts. I think it is well detailed, and majority of what we'll be covering in my session will now be briefly explained based on your explanation that you have given. You've really detailed all the information necessary for both personal income and also for companies. However, we still need some details for us to prepare ahead for 2026. You know, it is good that we have everybody in this, we have a lot of people in this session because, you know, it is good we prepare for the eventuality that will actually happen in 2026. So thank you. So let's move to the first slide, please. So what I will be speaking on is the navigation of the Nigerian Tax Act. So the first thing on the slide is key objective of the Nigerian Tax Act. So what are the key objectives of the Nigerian Tax Act? It talks about the harmonization of the existing law. We have prior to this time, we have company income tax, we have personal income tax, we have capital gain tax, all in separate laws. So the Nigerian Tax Act is now bringing everything together as one law, such that it will be easy for implementation and also administration. So the second objective of the new Tax Act is the reduction of multiple taxation. So as we all know, we have different forms of tax earlier. We have issues of federal government and state government, in the sense that the federal government will be charging VAT, while the state government will be saying they want to charge consumption tax. So all this has now been agreed and harmonized in such a way that the tax authority, the taxpayer, will not have to be worried about multiple taxations going forward. So also in the objective, we have the improved tax administration and enforcement. So like I said earlier, all this harmonization will also bring in the to ensure that this administration and enforcement is well established. So also the expansion of the tax base. Prior to this time, like my former speaker have said, we have a situation where a lot of people evade or avoid tax due to the fact that the tax law were not properly explained. So now we have all the tax laws properly explained, such that a layman can even understand what it is all about. So we also have increased in transparency and ease of compliance. So the new tax law is bringing transparency and also the compliance of the part of the taxpayers. So next slide, please. So who is affected by this new tax law? That's a question that comes in the mind of every taxpayer, be it personal income taxpayer or company income taxpayer. So the people affected by this law is the small and medium.
Did not connect.
Hello, please, can we mute our mic so that we can?
Let's stay muted, please. Thank you.
Yeah, Mr. Mashud, you can unmute your mic.
Hello?
Yeah, we can hear you, sir. You can continue.
Okay, so I don't know where I stopped before my mic was muted. So let me just proceed with this slide. Who is affected by the new tax law? So we have the small and medium enterprise SMEs, the large companies, multinational companies, startups and digital business, employers and employees. So for small companies, it is well explained by Abraham earlier that for some small companies, if you are making below 100 million naira as revenue, going forward, you will not be filing company income tax. However, I think the details we didn't touch on is the you not paying company income tax, but when a profit is distributed to you, you are still subject to withholding tax on your dividend. So that's for small company and medium enterprise. So for large companies, the effective tax rate is still at 30% currently, but it is still being reviewed, as Abraham has said, but maybe by 2026, it's going to be reviewed to 25% going forward. So multinational companies, the new tax law also expand the profit shifting and also profit shifting of multinational companies, such that it is very difficult for companies now to shift profits from one location to the other, just to avoid taxes. So startup and digital businesses, prior to this time, we don't have digital assets as part of our tax law before, but now we are bringing it in such that we can now tax digital assets going forward. So employees and employers, what are the things that employees and employers needs to prepare for? So we know that for employers, for small businesses, for small and medium businesses, if your company is a small business and you are not paying more than 100,000 naira, so there's no point for you to file personal income tax with the state authority, because the taxes for individual that is paying less than 800,000 naira per year would be subject taxes. Hello? Hello? Sorry. Hello, can you hear me? I don't know. Please
Yes,
confirm if you
we
can
can
hear me.
hear you now. We lost you for some seconds.
Oh, sorry about that. So, as I was saying, employers and employees. So for employers who are small and medium businesses that you pay your business, you pay your employee maybe like 800K per annum. So you don't need to file tax because your tax is at 0%, because all those your employee, they are not you are not paying them at the rate that will now be subject to tax. Also for employees, they have a progressive tax going forward in such a way that as you earn more, you are paying more taxes. So let's move to the next slide, please. So what are the major challenges business should note going forward? So number one, we have streamlined tax filing and reporting requirements. So now the tax law has streamlined the filing and reporting requirements for companies and for also personal income tax. So revised penalty, Abraham has touched on that. The last slide that he took, it talks about the penalty. But you know, one thing we should keep in our mind right now is that the cost of not paying tax is much more than the cost of compliance. So what the new tax law is trying to bring to ensure that we put in place is to ensure that people, when you comply with tax, you are paying less tax. When you don't comply, you are paying more tax. So going forward by 2026, we should ensure that we comply with taxes, because we not complying will result to us paying more than what we are to pay if we are to comply with the tax law. So also we have enhanced focus on electronic tax administration. So Abraham has also touched on this for the new synchronized invoicing, where FIRS, which has now been renamed to Nigerian Revenue Service, they are now introducing an electronic invoicing, such that if you are going to put that into your system you synchronize it with your system. So when you are invoicing, you are going to, the FIRS is going to have a barcode on your invoice. So we know the VAT and also probably the withholding tax that we have to charge on that invoice. So that is also a part of major changes in business that we need to look out for. So we have clearer rules on withholding tax and VAT compliance. So now it is well explained. If you look at the tax law, the withholding tax and VAT is now much more explained. So we have stronger enforcement and audit mechanism. So like I said, it is very hard for you to now say you don't want to pay tax now, because the new tax law, it has streamlined every hole that we have in the previous tax act, that has now blocked every loopholes that we have. So let's ensure that we comply as individual and also as companies. So let's move to the next slide, please. So what are the things that you need to do as a business owner? What are the things you need to do just to safeguard yourself in the coming years? So the first thing we need to look out for is the review. So you need to review your business structure. So what do I mean by reviewing your business structure? So first, you need to first assess whether your current structure is tax efficient. You need to look at your whole company, whether the system you have currently is tax efficient. Is it that when you invoice, you always forget to charge your VAT, or probably at the end of the month, at the 21st of the month, you don't file your withholding tax and VAT returns? So you need to look at all those systems and ensure that there is no loopholes at all, because the cost of you not complying with all this regulation is going to have a great impact on your businesses. So review group structure and related party transaction. Like I said, if you have a business outside Nigeria, you need to look out for all those things. And probably you have a company outside Nigeria and also you have the subsidiary in Nigeria. You need to look at the arrangement with the new tax law such that you don't default in tax compliance. So we need to consider implication for holding company interest, just like the way, like I said, you need to look out for companies that, if you have a joint venture either in Nigeria or abroad, you need to look out for them, because the new tax law is making sure that all the loopholes around these areas are blocked. So let's move to the next slide, please. So the next slide is, we update accounting and our tax record. So going forward in 2026, as we are moving into 2026, what we need to do is to ensure proper bookkeeping, aligning with IFRS and tax rules. So small business owners who do not think that they need an accountant, a lot of our small and medium companies right now, some of them just do their one-man business alone. They don't keep proper recording, and also they are not privy to IFRS and tax rules. So medium companies and small companies should also ensure that they have an accountant. If they don't have an accountant, they should employ the service of our consultants to ensure that all the bookkeeping and also the tax returns are properly filed, such that we don't have issues on non-compliance. So we need to separate taxable and non-taxable income. Like I said, it takes a whole lot of analysis for us to come about what is taxable and what is not taxable in our expenses. Like I said, the new tax law is now the way we analyzed our expense before. We used to have only exclusively necessary and reasonably. So the new tax law is now telling us that there is nothing like reasonability and there is nothing like necessity. So they are giving us two criteria now to identify our allowable expense, which is number one, wholly. That is, that expense, if we don't make it for the business, is going to impact on the business. So, and also we also have exclusively. So if that expense is not made for that business, it's going to impact on the business. So all these two criteria is what the tax consultant will use to identify some of the expenses that you are making, just for you to use it to reduce your tax liability. So maintain detailed documentation for expense and deduction. So like I said earlier, we need to properly keep account of what we are doing, because all these expense that is what we are going to use to net off our revenue, such that we can we can come to an adjusted profit that will be used for tax. So next slide, please. So we need to strengthen VAT and withholding tax compliance. So how do we need to do that? Number one, we need to reconcile VAT collection and remittance monthly. Like I said, we need to file our return and collection of withholding tax monthly before 21st of every month. We need to file our return. So we need to reconcile them with all our invoices to ensure that we are paying the appropriate taxes. So we need to review withholding tax deduction and timely remittance. Same as the VAT, you have to file your return 21st of every month, before 21st of every month. So you need to file that every month, such that we don't underpay our withholding tax. We need to review our invoices so that we don't underpay our withholding tax. So we need to also address unremitted or under-remitted taxes proactively. So that needs to be addressed, because the cost of compliance is lower than the cost of non-compliance. So let's move to the next slide, please. So we need to leverage on technology. So we need to leverage on technology. As we all know, the new tax law is now synchronizing our accounting software with the tax software, such that all invoices that we now upload on our accounting software will now be reviewed, will now be seen by the tax authority. So we need to adopt accounting and tax software such that we know the appropriate tax we are going to pay, and also the expenses that is allowed to be deducted for tax purposes. So use FIRS and state tax electronic platform for small, medium, and for small businesses. We all know that some of them might not be able to employ the service of a tax consultant or an accounting firm to look at their books. So for you to comply with taxes, we have a provision from the LIRS, or State Internal Revenue Services, and FIRS, such that once you put your income and also your expenses in those chat box, they can generate a tax payable for you. So I think that will also help the small, medium businesses to reduce the cost of doing their businesses. So we need to automate tax calculation where possible to reduce errors. So for this, large companies has a way of imputing this tax calculation in their accounting software, such that this can also help reduce human error, and also ensure compliance. Let's move to the next slide, please. So manage tax risk proactively. So how do we manage tax risk? We conduct periodic internal tax health check, just to ensure that we are in compliance with all taxes and returns. So we prepare for tax audit and investigation. So how do we prepare for tax audit and investigation? Is to ensure that all our expenses are properly documented, when the tax audit guys comes, we can present all expense and also present all our documentation to ensure that the investigation goes smoothly. Address historical exposure before regulatory review. So we need to look at what we have been doing before to ensure that when the tax authority comes, they won't have to be looking at our book twice. So we would have corrected all the errors that we need to correct and ensure that we are in compliance. Next slide, please. So we need to train our key staff. Like I mentioned earlier, small, medium businesses who do not have money to recruit accounting and tax experts. So the in-house person that you want to take charge of your businesses for large companies, we need to train our staff in all these areas of the new tax law, just for them to be aware of the changes in the new tax act. So first thing we need to do is to educate our finance and payroll teams. A lot of changes that happen in our payrolls, and also a lot of changes have happened in terms of our company income tax. So the cost of, like I said, the cost of non-compliance for all these taxes it outweighs the cost of compliance. So take for instance, Abraham mentioned that if you accept a contract from someone who do not register for tax, to file tax, you are liable to pay 5 million naira tax. There is also another area where I need to also shed more light on. So as a company, if you accept an invoice from a vendor and the vendor did not have a tax identification number, and you did not charge VAT on that invoice. If you don't charge VAT on any invoice, such invoice cannot be used to claim allowable expenses. So any invoice that you did not charge VAT on will not be used to claim allowable expenses. So let's keep that in mind too when we are looking at our allowable and disallowable expenses. So the second thing we need to look at is to ensure that management understand tax implication of decisions. So like I said, we need to look at the implication of all these taxes and ensure that we are in compliance at all times. So engage tax professional for complex matter. For medium companies who has enormous resources to engage tax professionals, for large companies, it is best we engage professionals in our day-to-day activities such that we will always be in compliance at all times. So let's go to the next slide, please. Next slide, please. So what are the common pitfalls to avoid? The first thing, ignoring transitional provision of the act. So just saying, is it not Nigeria? That's how we always do that. There is nothing they can do. We feel like it is business as usual. So it is actually not business as usual. The new tax law, the current government is aggressive in revenue generation. So I believe there is a political will to generate revenue. So don't let us be in the situation where we will now be at the mercy of the taxpayer. So poor documentation and record keeping. So like I said earlier, we need to keep our record proper description. If you want to send money for any expenses that relate to your business, make sure you put a proper description such that you can use that description to track that expense, and the tax authority can also see from that description that this expense is actually allowable under the tax law. Because you not putting the expense, you might incur an expense that is allowable and it is now disallowed. All these things will impact on your taxes, because if allowable expenses is now disallowed, it will impact on your adjustable profits, which will now be used to subject you to tax. So late filing and remittance of taxes. So late filing attracts penalties. So let us ensure that we don't file our taxes late. So treating tax compliance as an afterthought. So I forgot to file the tax at the 30th of the month, at the 30th of every month. You didn't file tax before 30th, after 21st, I mean. So you are now thinking, okay, I'll file it probably on the 30th of the next month. So all this non-compliance, late remittance fee and all what's not will be applied to you. So let's ensure that we treat taxes as it is when due. So let's move to the next slide, please. So what are the action plan for businesses? So the action plan for businesses, we need to conduct a tax impact assessment. How do we do that? Like I said before, any expense that you know that is expense for your business, put a proper description on when you are sending money to anybody. Put a proper description, be it for individual or for companies. When you are sending money going forward in 2026, make sure you put a proper description. You can't send money to somebody as a gift. When the person receives such money and the tax authority is seeing it as a payment for a service, that money you send to the person will now be subject to tax. But on your own end, if you gift somebody and you feel like, oh, that gift, if you now use it to reduce your tax liability, the tax authority will tell you that no, gift is from your own goodwill. You don't use that to reduce your tax liability. It is only when you incurred expense that is attributable to the business that will now be subject to allowable expenses. So we update our internal tax policies. Currently, there's a lot of changes in the Tax Act. We need to update our internal tax policies to come in line with the new tax law. Like I said earlier, you engage professional tax advisors. So ASC is one of the professional tax advisors that I believe we can engage in when we have any issue on our taxes. So let's engage a professional tax advisor, not just for us to comply with all the relevant taxes. So implement a compliance calendar. So I remember when I was working with a firm where we file withholding tax, and also we file VAT, and also we file payee every month. So there is a calendar that I usually have that reminds me every time that, oh, withholding tax is due and VAT is due at this date. Payee is due at this date. So it sends a reminder automatically to me, just for me to quickly upload all those things. Because if I don't upload them, the tax authority will penalize me for non-compliance. Next slide, please. So what are the key takeaways in this new Nigerian tax law? Number one, the new Tax Act 2025 requires early preparation and proactive compliance. So we need to start planning from now. We need to start planning. We are not in 2026 yet, but we need to start planning. We need to start looking at our payee. We need to start looking at our CIT. We need to start looking at reviewing our invoices and how we are going to ensure that all those invoices is in compliance with the new tax law. So we need to start that now so that when 2026 comes, we don't have to now be doing trial by grade approach on the relevant tax act. Excuse me, please. So businesses that adapt quickly will reduce risk and cost. So the early adaptation will reduce risk to also reduce the cost of non-compliance. Practical implementation is key, not just understanding the law. So we need to understand the implementation. That is why we are in this webinar, to ensure that we understand what the new tax law is all about, such that we don't have issues when it comes to compliance. Next slide, please. I think this should be the last slide. So thank you very much for listening. And I believe so far we've been able to get information on all areas that we need to use to prepare, on for these taxes. Thank you very much. Thank you so much.
Thank you so much, Mr. Moshood. That was a very, very insightful session again. Very insightful session. It says, keep your house in order, keep your books in order. Like you said, the cost of not compliance is higher than the cost of compliance. So it's really a time to be compliant, because you benefit more by being compliant. So engage accountants to keep your books in proper records. Engage tax consultants. ASC is here for you to advise you on the right thing to do, the right taxes you're supposed to pay, when to pay, and everything, how to be compliant. Thank you very much, Mr. Moshood, for that session. And I'm very sure we all gained a lot. We are gaining a lot. So the next session we are moving into is the frequently asked questions session. This is the point where we are going to bring out many questions that we've heard people have concerning this new tax reform, and we will be providing answers to all the questions. And also, this is the time where if you have a question, please raise up your hand, or you quickly drop it in the chat box. We'll be coming to that right after this frequently asked question. We'll be coming to those questions. If you raise up your hand, we'll call on you, and you're able to explain the questions, how you want to ask it, and we'll be able to, and I'm very sure we have experts on the house that will give you proper and accurate answers to those questions. Thank you very much. So we'll be moving to this session right now for the sake of time, and Mr. Shegun will be anchoring this session for the frequently asked questions. Mr. Shegun, sir, please take over.
Yeah, thank you very much.
Mr. Shegun, all right.
Yes.
Yeah.
Thank you very much. Please confirm if you can hear me.
Yes, can hear you very well.
All right. Thank you so much. I believe we all have been gaining from the webinar. Please, if you are gaining, or if this session has been a great one, let me see your reactions. You can react, and let's confirm that you are actually doing what you are doing. Okay, Jane, I can see your reaction. Thank you very much. Yeah. Oh, nice. Lucky Naiwi. I'm sorry if I didn't pronounce that correctly. Thank you so much. Thank you so much. Salawu, thank you very much. So this shows that we are actually gaining something from the webinar, and I believe it's an insightful one. I will be moving straight ahead to the frequently asked questions. These are questions that we've been getting at ASC and we tried as much as possible to provide answers to them. Yeah, and of course we'll be getting more questions from you just for clarification. Quickly, the first question here is, when does the Nigerian Tax Act take effect? This, I'm very sure, is not new to us, but like we said, we frequently asked questions. So the new Nigerian Tax Act takes effect from January 1, 2026. So come January 1, 2026, you'll be seeing the Nigerian Tax Act take effect. The next question: are small companies exempt from companies income tax and other levies? We've been hearing this from our speakers. I think Mr. Abraham Dunku mentioned this. Mr. Moshood also mentioned it. So yes, small companies are exempt from companies income tax, capital gains tax, and development levy. If you need more clarification, like I said, you can drop it in the chat box. We'll pick it up from there. Digital and online businesses required to pay Nigerian taxes? Absolutely. Yes. Digital and online businesses providing services to Nigerians must comply with Nigerian tax laws. So your remote jobs, when they start charging you for taxes, just know that it's the Nigerian Tax Act that is taking effect. Yeah, and then what is the correct small company threshold under the new tax laws? It is 100 million. The 50 million in the NTA was a drafting error, and the NTA override conflicting provision. I think Mr. Taiwo also did a clarification on this. So it is 100 million. That is the threshold under the new tax law. Do I need a payer ID to operate my tax account? Yes, under the NCAA 2025, every taxable person, any income from trade, business, or economic activities must have a payer ID, except students and dependents. Mrs. Temitope emphasized on this, so you need to get your tax payer ID. The next question here is, will transfers and deposits into my bank account be taxed? No. Moving money around, whether via POS, transfers, deposits, or withdrawals, is not taxable. Only income earned is subject to tax. This particular question is a point of interest for me, because from normal other conversations with friends, I've been seeing people mentioning that, oh, January is coming. Tinubu is this, Tinubu is this, Tinubu is that. January 1, every money coming to my bank account, they will deduct tax, they will do this. No, it's not true. So moving money around, whether via POS, transfers, or deposits, or withdrawal, is not taxable. Only your income and is subject to tax. That's the simple answer. And the next slide here: will tax authorities now monitor bank accounts of businesses more closely? Of course, you once your business is registered, automatically you get the tax identification number, and this automatically will, or in short, the at the point of getting your tax payer ID, which is mandatory, you are exposed to tax, and the authorities will be able to monitor you closely, which I believe is not even something to worry about if you are doing the right thing. I run a one-man business. Do I pay personal income tax or company income tax? If your business is registered as a sole proprietorship or a business in application deed, you pay personal income tax. If it's a limited liability company, you pay company income tax. So that's who is exempt from personal income tax. Individuals earning the national minimum wage or less, or those earning below 800,000 naira annually, are exempt. Mr. Abraham Dunko also did a clarification on this when he explained the percentages. Yeah. Then if I sell shares and make a profit, will I pay tax in 2026? Oh, of course, we are not paying. No, as long as the shares sold are not more than 150 million naira in value, and the gain does not exceed 10 million naira. Gains above this threshold become taxable. I believe is also fair. If I earn dividends on rent abroad, will Nigeria tax me? The answer is dividends, interest, rent, royalties earned from outside Nigeria are exempt from tax, provided they are brought into Nigeria through approved channels, like banks. Yeah. Okay, I think this should be the last question here. The last question is, do creative professionals, authors, musicians, actors, comedians, sportsmen, still enjoy tax exemptions on foreign income? No. They are now required to pay Nigerian tax on all income earned, whether within Nigeria or from foreign sources. So these are our frequently asked questions, which I believe must have answered most of your questions, or some of your questions, so to say. And if you have other questions, I can see some hands up. I will hand over to James so that he can moderate the question and answer section. Thank you so much.
All right, Mr. Thank you so much. So I see hands raised. The first person right now is sorry if I'm not pronouncing your name right. Sorry, Salawu Zubaru. Please, you can ask a question. Mr. Shogun, please unmute him to ask his question.
Oh,
You can unmute yourself. Mr. Salawu Zubaru. You can unmute yourself to ask your question, sir. I'm sorry if I'm mistaking the name.
Oh, okay. He's currently on note. I will bring him on board now.
Hi, Chef, confirm if you can hear me.
Yes.
Yes, I can hear you, sir.
Thanks to everyone for taking time out to attend our webinar. I noticed the listing. We have a number of participants. That we are doing the needful. So we've addressed a couple of questions in the chat box. I think we can also refer to that. And for some of the questions, they are repeated questions. We've also made content on them on LinkedIn. A very good example is for somebody that is not working in the country, will they pay tax on their earned income? The answer to that is yes, but a more detail of it is there in our content. So we can also refer them to our content so that we can make best use of this time. Thank you. So let's take like just 2 questions and we can call it a day. So people can also go to others. Thank you.
All right. Mr. Lucky, I don't know if you're available. If you can unmute now to ask your question. Mr. Lucky Nainwi.
Okay, Mr. Lucky, you can unmute yourself now.
Good afternoon. Can you hear me?
Yes, we can hear you. Good afternoon.
Yeah, we can hear you, sir. Thank you, sir.
Okay, partly the question I want to ask, I put it in the chat box before and it has been partly answered, but let me just still repeat it. We are operating in the fast-moving consumer goods, environment, and then we buy our goods, our stock directly from the manufacturers. And before now, we are not permitted to charge our manufacturer, our vendors withholding tax. The law, exempt us from charging withholding tax because they are the manufacturers of the goods that they supply to us. But we have other expenses, like maybe we make other payment that is not for goods purchased from our manufacturers. Are we supposed to, charge a withholding tax or the no withholding tax on that? That is number one question. And if we've not been doing that, from January 2026, what effect will it have on us, looking backward? That's what I want to find out, please.
All right. Mr. Afif, please, can you take that question, sir? Sure. Okay, Mr. Abraham wants to take it. Okay.
Okay, that's fine. Abba can go.
Okay.
Yes, thank you very much for that question. Yeah, thank you very much, Jane. So basically, with the new withholding tax regulation, it is crystal clear. The the transaction you want to deduct withholding for, is it listed among the list of transactions we have in the 2024 withholding tax regulation? If it is, if the transaction is probably maybe an interest, royalty, rent, lease, commission, technical fee, management fee, if it isn't, if the transaction falls in line with transactions like this, yes, you have to deduct withholding tax. Now, if you have not been deducting withholding tax, what is the implication for the company going forward? It means that when the taxman will come to audit the company, they are going to request that you pay that withholding tax, that you have failed to charge, even if you have paid your customer, you have paid your vendor in full. So the liability will be, the tax burden will be borne by your company. So as long as the transaction you are talking about falls among the list of transactions in that withholding tax schedule, yes, you need to deduct withholding tax. And if you have not deducted, the liability of the tax burden will be borne by you, even if you have paid your vendor in full.
I think we lost him. Or are you still with us, Mr. Abraham?
Yeah, I'm still here. I'm done. I've answered the question.
Oh, okay.
Yes.
Okay, so Mr. Lucky, I hope that answered your question. So we'll be moving to Mr. Mustafa Adenkule. Please, can you kindly mute yourself to ask your question?
Yeah.
Mr. Mustafa, okay, thank you.
Thanks to the panels of the ASC. So let me straight to the point. If a company is exempted, the small companies are now, does that mean it's not going to file tax return? That's my question. And also I have the comment side of it. I don't know, maybe I'm communicating.
Yes, sir, we can hear you very well, sir.
So I just want to confirm, if it's a small company, I know it's exempted from CGT, it's exempted from the CIT as long as it meets the threshold. But does that mean I'm not going to file, or do I still need to file? Then on the commentary side of it, I want to talk on the issue of the pioneer status, whereby when one of the presenter, person of Mr. Abraham, is presenting, I think part of what justice I felt needs to be done to the pioneer status based on the new tax reform is that the new tax reform have given a lot of opportunity in terms of the minimum investment and giving priority to some certain sectors. And most of the pioneer status is from 15 to 20 years. So those are kind of commentary I just feel like to add to that. That's for it. And on the issue of the CGT, for these institutional investors, if you've already met the threshold of the 10 million as a return and that of the 150, and in terms of your sales proceed, there's an avenue whereby you can use the loopholes to be reinvesting in the capital market, whereby you're not going to be paid or have the ability to pay the CGT. So those are my commentaries on the question I wanted to ask.
All right, thank you very much. Okay.
For me. Can you hear me?
Yes, I can hear you.
Yeah, apology, I won't be able to display my camera. I'm driving. Just a bit of contribution. Thank you, Mr. Lucky. Yes, you are quite correct, and that's spot on. However, it is also important to support of this to say what you have just mentioned is a principle under the rule over relief. So it has always been part of the CGT, right? It's nothing new, but now it is now widespread. So that is something we at ASC we also do a content thing. You should be able to see the light of that on LinkedIn. Thank you for your contribution, and we appreciate it. Abraham, over to you.
All right, yeah, thank you very much. Mr. Hafiz, for that. So, with respect to your first question, which is on small companies. So, small companies are exempted from paying taxes and all of that, but they are required by law to file their tax return. So, yes, they're exempted from payment, but they're required to file so that the tax authorities can track the progression and the growth of the business. Now, with respect to your second contribution, thank you very much for that. And with respect to the third point you made on shares. So yes, it's also something we also mentioned that when people dispose of their shares, and if such disposal or the proceeds from such disposal is reinvested, they are exempted from paying tax on the income they get from such disposal. So yes, we mentioned it, and it's part of what we have in the material slide as well, which we'll be getting after this session.
Okay, thank you. Thank you all. We'll be moving to the chat box now to answer some of the questions there. So one of the questions I'm seeing here is from Afiz. So he said, what is the impact of the NTA Act on business name or ventures? Is the small upgrade threshold applicable? Mr. Abraham, did you get that question? Mr. Abraham or Mrs. Temitope, please.
The impact of what?
Okay, it said, what is the impact of the NTA on business name or ventures? Is the small upgrade threshold applicable?
Oh, okay, yes, definitely. So, for business names, I mean, their tax is covered under personal income tax. So business names do not pay company income tax. So by extension, it means that the increase in threshold of small companies to 100 million doesn't affect them, because the income from earned by business names, partnerships, and the likes, the tax for those income is taxed in the hand of the proprietor. So the classification of small companies that is below 100 million obviously does not affect them. So except if they now change or switch to a limited liability company, that is when the small company threshold will then cover them. So they are going to be paying tax, the personal income tax, on the income that the business makes, which will be taxed in the hand of the proprietor. So there are two different scenarios. Business name, enterprise, cannot pay company income tax and do not fall under the small company category, because the jurisdiction of their taxes is under the personal income tax. So they are going to be paying personal income tax on the income the business makes, because it is not a registered company, not a limited liability company. When they then register AHA, that is when they can be concerned of the small company threshold of 100 million.
All right. Okay. Thank you very much, Mr. Abraham, for that. And let me quickly take some other questions from the chat box. Let me see. Okay. What is the impact of the NTA Act on business name or ventures? Is the small upgrade threshold applicable?
This question has been taken.
That's the one we just took now.
Okay.
Thank you, sir.
Okay. Yeah. Let me see. When a company sells an asset and pays CGT, that's capital gain tax, on the asset sold, would the proceeds be exempted from CT, especially for companies whose financial period falls between both old law and new law?
Okay, so to answer this question, let's start from a simple basis. Effective 2026, companies that sells off assets, the income from such disposal will be taxed alongside their company income tax. So there's nothing like, oh, we are paying CGT separate anymore. No. When you're filing your annual tax returns for 2026 accounting year, you are going to say, okay, what is my company's taxable profit? What is my capital gains, income from disposal of assets? You sum it up together and you apply your company income tax rate, which is 30% on the income. So there's no more who you are paying CGT and you are paying CIT separate. That's the answer to the question.
Okay. So if SMEs are exempted from CIT and CGT, does that mean there is no need? Okay, I think you've answered a similar question. So let's check it. Let's go. Okay, I think most of the questions they have actually been answered in the chat box by ASC staff. Okay, so I'm getting questions on if the recorded expression will be shared. Of course, it will be shared. You will also be getting this particular material we are using for presentation. So you'll be getting them via your mail. This is one of the reasons why we asked you to register on the website so that you can get your email addresses. So we'll be sending you the recorded session and the presentation, of course. Okay. How is the new tax? I think this is one area that was not touched. So how is the new tax law affecting the NGO? Mr. Moshid, I don't know if you are there to answer this or if there's any of our speakers that can take this up. How is the new tax law affecting the NGOs?
Okay, so can I take this question?
No problem. No problem.
So yes, we understand that the income earned by these NGOs are exempted, largely exempted from tax, as long as they do not drift out of their, their exempted services or exempted structure. Yeah, they are exempted from tax, fine. However, the new tax act requires them to register. They must have a team. They must register and formalize their identity. They must be known. They must be in the tax net, even if their services, their business structure is exempted from tax. Now, in the event that they can't have any service or any line of business that is, outside their scope, of exempted services, they are going to require to pay tax on those that line of business, on those incomes earned. Also, they are required to file their annual tax returns, the annual, performance of their operations, even if they are not paying tax, they are required to file. All right. So if they don't file, they will pay penalty. So that is where the NTA affects them. Fine, your company, your service structure is exempted from paying tax, but you have to file. When you don't file, the NTA affects you. How? You pay 100,000 as penalty for the first month, and 50,000 for every subsequent month you fail to file. Aha. Now, also, these NGOs are required to, deduct any other transaction taxes, when they are dealing with contractors or when they are dealing with any other, individuals, when they are dealing with any other individuals. Also, the fact that NTA has said that any person you are dealing with now, you have to ensure that they are registered for tax purpose. If an NGO deals with a company or an individual that is not registered, the NGO will be required to pay a penalty of 5 million, even though their service structure or their business line is exempted from tax ab initio. That's a very short answer to that person's question.
Okay. Wow. Thank you so much. Thank you so much for that. We have a lot of questions here, but I think I'm not sure we'll be able to take all. We've been here for over 3 hours now. Let me just take one more question. That will be the last question. Then we'll round it up for today. So let me see. Okay. So this person, Mr. Yekin Abiodun, said, thanks for this opportunity. My question: catering services with monthly turnover of 200,000 naira above register with TAC, but using personal accounts for transactions. How will such enterprise be taxed under NTA? Thank you all.
Okay.
Mr.
So,
okay, Mr. Brown.
Mr. Mitokwe, do you want to take this question?
Okay, she's not there. You can just pick it up.
All right, so that's about time. So if a catering service setup makes a monthly turnover of 200,000 above, okay, of 200,000 above, this is not very clear. So let's say the catering service company makes 200,000 every month, registered with CAC, purchasing personal account for transportation business. Do you mean the person is running a catering service and also running a transportation business? This is not clear.
Not transportation. She said, but using personal account for transaction.
Okay, I can say a transaction. Okay, for transaction / business. Now this is it. How will such an enterprise be taxed under NTA? Now, first of all, you call this an enterprise.
Yeah.
I want to believe it means that this catering service is not a limited liability company. So if this catering service outfit is not a limited liability company, the income from this outfit, from this enterprise, will be taxed, on the hand of the owner of the business, the proprietor. All right, so that will be under the personal income tax. Now, whether the person is using personal account or corporate account, it doesn't really affect the tax as long as they can, provide records of their transactions, so what their revenue is, so what their expenses are, that the taxman can then arrive at their taxable income or their taxable profit that will then be taxed in the hand of the owner of the business. Now, even if this catering outfit or catering services structure is registered as a limited liability company, what then will be the implication? The income of this outfit will be taxed, as a separate legal entity, all right, under the company income tax outfit. It then means that the tax for this outfit will be taxed in the business name, not in the name of the owner, not in the name of the proprietor. Now, since you said 200,000 monthly, that means that the company will be less than annually, will be less than 100 million, which very means that the company's tax rate will be zero. This catering business will not be paying any tax because it will fall under the small company category of 100 million, and then their tax rate will be zero. That is the answer to your question.
Thank you so much. Yeah, thank you so much. Thank you very, very much. I think that would be all for today. Mr. Okwe, I can see the emphasis on your question. The simple answer is yes, please make remittance after filing your tax returns. Once you file your returns, just make remittance. That's the ideal practice. Not that you might not actually have to, pay instantly, but there's a what's it called now? There's a time frame for you to remit your tax, and ideally, once you file your return, just make your remittance. That's the ideal practice and the legal practice. So I think that will be all for today. That will be all. If there are any other clarification, especially for companies and businesses, we have our email address attached to the email sent to you. You can always reach out to ASC. We will do well to guide you. We are tax consultants. We are an audit firm, and of course, we are into consulting. We are happy to attend to your questions as long as it's related to our services. I think from here, I'll be joining the curtain as I bring on board. Jane, are you there?
Yes, I'm here. I'm here, Mr. Shegun.
Okay.
Can you hear me?
Yeah. So you can pick it up from here as we round up for today.
Thank you very much to all our speakers and to everyone that stayed to the end. Thank you so much. We really appreciate you. If not for you guys, we won't be here. We really appreciate. Like Mr. Shegun said, you can always reach us in our email. The email is displayed on the screen right now, and also the email that was used to send the link to you. And we'll be very glad to be at your services. ASC, we are client focus, so we give one of the best services. Thank you again for this wonderful webinar. We really appreciate, and we hope you learned a lot and you are well equipped for year 2026. Thank you so much and have a very wonderful day ahead. Thank you. Bye. Bye everyone.
Bye everyone.
Bye.
Bye.